That's part of the call, yes. And thanks for having me on, by the way. So,
Thank you.
defense stocks over time are pretty good companies. They have a naturally good business model, and they compound the cash flows over time. And it's true that last year, the geopolitical landscape became a tailwind to defense companies. The challenge is the budget ebbs and flows over time. It typically has actually strikingly consistent decade-long upturns and downturns. And we've had 8 years of growth in the defense budget, even before what unfolded last year. And then the price that the market's willing to pay for defense earnings also ebbs and flows. And after last year's large relative move, the relative valuations are also very high. The market will also, oversell defense stocks when the defense budget's going down, and there can be an opportunity to buy them at that point. But today, despite what you see in the geopolitical headlines, the bottom line as we see it is that defense stocks trade at all-time high valuations on all-time high budgets, and it's really hard to generate excess returns mathematically from that starting point.
Well, we know that the environment is toxic in Washington, and we know that we have to worry about that. Janet Yellen, the Treasury Secretary, sounding an alarm just today on the debt ceiling, debt expiry by June, having to take special measures. But I guess I'm wondering if we can really afford in this kind of geopolitical day and age, and also with some bipartisan support for what we need to do militarily and in the world, if we can really afford to cut defense spending.
Yeah, I mean, I'm not sure that we can afford to cut defense spending, and we're not really making the call that the U.S. will cut defense spending. The call that we're making is with where valuations are and what we hear from investors in the market. We think stocks are pricing in that the defense budget will grow, a nice steady 5-6% a year the next 5 to 6 years. If the defense budget is flat or up 1 or 2%, and the battle for the Speaker of the House talked about taking 24 spending back to 22 spending, so that would be down a little bit. If it's just flat or slightly up, that's worse than what's priced into the stocks. So the call here is not a reversal of or solving of the geopolitical situation. It's really that what's priced in is a very robust scenario.
You highlight, I just want to point out two names because NOC and LMT go to sell. Why those in particular more vulnerable to you? Is that a valuation call?
Part of it is valuation. Those have become the highest priced stocks in the group, especially relative to the market and relative to the peer set. And then they're also the pure plays. They're the bellwethers in the space that are 100% defense. Raytheon has a sizable defense business, but it also has a great commercial aerospace business. We're bullish on commercial aerospace. We've spoken about the Boeing call here recently. General Dynamics has a private jet business. We're bullish on private jets. We already had a sell on a few other defense stocks. So it's really just where there's that pure play defense, which is more vulnerable to risks to the defense budget in the multiple.
Looks like Wall Street's picking up on your more cautious stance here on defense. Those stocks underperforming today. Thank you for joining us to talk about it, Noah.